Hello and welcome to this monetary policy special on the minutes of the August 6th meeting. While the press conference on August 6th had indicated practically no room for another cut, we called it a hawkish pause, the minutes of the meeting show that most members actually prefer a wait-and-watch mode and sound ready to cut if growth worsens, probably because of tariffs. Now, the RBI members, that is Governor Malhotra and DGs Poonam, Gupta and Rajiv, Ranjan, sound a little more sure of growth remaining resilient. External members Nagesh, Kumar and Singh clearly sound more concerned about growth. Today, I have with me Saugata Bhattacharya, the member who sounded actually almost neutral. So let me first get to Mr. Bhattacharya. Thank you very much, Saugata, for joining us. Let me start by asking you whether our interpretation is right. Was the mahal, the mood in the meeting such that we don't know enough, but it was not like, no, there is no space to cut?
Hi, good morning, Latha. Thank you again for having me on your show. Always a privilege. From I'm not going to talk about the mood of the meeting, the other members, etc. Because they will be expressing their own opinions on your show. My thinking is, that the familiar saying that if you're in a dark room with oil spills on the floor, the optimal action is to stay put. So given this level of uncertainty, obviously, and from my point of view, again, from the June meeting where I had voted for a 25 basis point cut, if anything, this action would have led to another 25 basis point and then pause. So from my point of view, it was a done deal right from the beginning.
Okay, fair enough.
But there are too many uncertainties at this point in time. As all of us have said, that it's best to wait and watch at this point in time, see how the macro-financial conditions evolve, and then take a view going forward.
Okay. Would you say that on August 6th, we all had limited information about how the tariff situation evolves? Now we are all a little wiser. Are you getting a sense that growth is in for a bigger battering since 50% penal tariffs look imminent, at least for some weeks?
No, absolutely right. That at the beginning of the meeting, at the beginning of August, we just knew of the penal tariffs. We had no idea what the penal tariffs are likely to be. Only later, after the meeting, did we get to know the additional 25% tariffs. So again, I don't know again how the trade environment, India's relative tariff position vis-a-vis our emerging markets and other competitors, export competitors, are likely to play out. But yes, if the 50% tariffs stay for the rest of the year, then this is probably likely to hit growth. That's the logical conclusion. We are already seeing it's not just the immediate impact on exports to the US, but the secondary, tertiary, and other considerations which you're already hearing from MSMEs, the industrial clusters, etc., loss of employment, the slowdown in affordable housing from the MSME sectors, etc. There's a whole chain of events that will play out over a period of time. So yes, if these tariffs persist, then it is very, very likely that growth will take a hit. But the problem in this is that we don't know how much of a further easing on monetary policy is likely to help. That's the problem. The essential demand versus supply of credit story that you know very well, that your viewers, your audience knows very well. That's the problem.
Yeah, fair enough. Perhaps a way to answer it is not monetary policy, but a special fiscal package from the government for targeting only those who will have to bear that 25% penalty. And I believe something is in the works. But Saugata, you're the only person who is referring to the negative impact on household savings if we relentlessly cut interest rates. Is that a worry, household financial savings?
Yes, it is a worry. I'm speaking for myself. It is a worry. We have already seen that bank deposit growth has not been very good, and even the mix of the deposits, coming in more from the bulk wholesale deposits And you know the approximate reasons why. I mean, a lot of household savings, given the relatively low returns on the bank deposits, are preferring to invest in other financial market instruments, etc. And those are coming back into banks via more of wholesale deposits, which in itself creates a problem of volatility because wholesale deposits are much more volatile than the rather sticky retail deposits that banks typically rely on. So that is a problem, and particularly given this current external environment, where I'm quite pessimistic about foreign savings. I mean, offshore savings are not going to be as high as it used to be. We have relied China, for instance, with a 50% savings rate and a growth of 9-10%. That is no longer going to be a savings pool that we can rely that the global markets can rely on. Global central banks are tightening, etc. So offshore savings might be a problem, and in that context, I think India, for its very ambitious investment goals, growth goals, needs to rely more on domestic savings. So there always has to be a balance. Monetary policy is basically managing the trade-offs in various dimensions, and this borrowing versus depositor trade-off has always been a fairly large component, and it's particularly now it's coming up, it's getting emphasized over the last couple of years. Now that the liquidity environment has begun to tighten compared to what it used to be before.
No, actually, it's most welcome that you are raising this issue. The only other central banker who raised this issue, brilliantly in our own CNBC TV18 Global Summit last year was Dr. Rangarajan, who said that, you can ask for rate cuts till the cows come home, but remember, there is another side that's getting impacted, the savings side. Saugata, the other point we now know and we didn't know on August 6th is the GST cuts. That will have its own impact on some items in the CPI basket. Does that give the Reserve Bank and the MPC more elbow room to cut?
Yes, it is. I mean, absolutely. That's the reason that I stay neutral on this, because as the situation evolves, with the GST cuts, with the previously announced income tax rate cuts, hopefully, and you've seen the effects. I mean, with the government, the income tax, direct tax cuts, the growth having slowed gross and net with the additional refunds coming in. So obviously, more funds, more resources are getting placed in the hands of households, other economic agents. So that is likely to help, and even with the GST rationalization. So obviously, the government gives up some revenues, and those revenues go back into the hands of increasing potential demand, the latent demand that we have always seen to stimulate. So that fiscal side is going to help. But again, from even there, I mean, it's going to be again a balancing act. So we need to see how demand plays out, how this domestic demand offsets a loss of foreign markets, a potential loss of foreign markets, etc. So even that needs to be sent. So, I mean, I think you're completely right. The way the entire policy environment, fiscal policy, manufacturing policy, trade policy is evolving, and how monetary policy fits into that overall domain. I think so. That's the reason. I'm not saying we should be able to cut more or we stay neutral. I mean, as the situation evolves, we see how domestic demand conditions evolve. That will be the.
I think we're losing. I think we lost the volume. Just want the technical team to check whether the volume is fine. Saugata, the other question I had is, do you think it makes sense for the MPC and the RBI to wait even beyond September 30th? Because the CRR cut starts only in September, and you will know the impact of the GST cuts also later. It may not even be announced by September 30th. So if there is space for cut, it should be kept for further down and not necessarily for September 30th. I mean, that's what some in the market are guessing, that it should come later. Is that a fair point?
Absolutely. I mean, you've put this absolutely brilliantly. I mean, we were thinking about the inflation path over the longer period. That monetary policy needs to look over the cycle, not just at the latest inflation print, how things are likely to evolve. But you've now brilliantly positioned the entire demand scenario, the other policy, the effects of the policy scenario into this mix. That multiple dimensions of the policy responses the policy response function, in other words, needs to look over a much longer period, over the course of the cycle, rather than just the individual print. So even if the Q1 GDP numbers, because that's a very critical number which will give you an idea of how demand moves. My own sense is we are going to get a fairly good GDP growth number because of the deflator issue. That with the low CPI and the negative WPI, we are going to get a fairly good print. But in case the GDP numbers come in worse than much worse than we currently expect, that will be a key trigger to my mind on how policy evolves. But I mean, I couldn't put it better than you just said. That this needs to be looked at over a longer period, over a cycle, and how things evolve, and particularly given this current level of uncertainty in the system.
Okay, fair enough. A last question, Saugata. You had said earlier that the stance is not put to vote. It's only the repo action that's put to vote. Nevertheless, as one so close to the policy making, would you say that the shift to neutral from accommodation was perhaps a tad too soon, since the ask is more cuts will perhaps be needed?
No, remember that I actually agreed with the shift to neutral. Remember, in the April policy, I had also written that my own prior was to retain the neutral stance rather than move to accommodating. So in the June policy, so I had agreed in the sense that, I mean, neutral means giving you the flexibility to respond as the situation. Nobody really thinks that the likelihood of a rate hike at this point in time is even on the horizon. I mean, it might happen. We never know what conditions, situations might evolve. But it's a very tail probability at this point in time. So neutral still means the option of holding on to the pause, or maybe the ability to cut rates going into the future. So I think the neutral stance is good. And as part of forward guidance, that also gives you a sense that that the MPC is not on a pre-committed rate cut path. It has to be done, and I've emphasized this in meeting after meeting in its part of my minutes, that this needs to be based on incoming data. And this is something that all global central banks have been communicating. Meeting by meeting approach, see the incoming data, cross the river by feeling the stones, because there cannot be a pre-committed path for rate actions.
Fair point. More so in these uncertain times. Point taken. Thank you very much, Saugata Bhattacharya, for joining us with your perspective on so many parameters that shape the monetary policy. That's it on this monetary policy special. Thanks for watching. After break, Chartbusters.